Good morning, guys. Welcome back to another episode about value investing. Today, we're going to talk about valuation, especially about valuation of a stock and can all stocks be valued? Let's dig deep into it. So, we can value anything that can generate cash. So, let's take an example. If I have a stock that generates cash today, then I can value it. What if it's not generating cash today? Can it generate cash in the future? Maybe a couple of years from now. If that is possible, then we can value it. If there is a stock that can never generate cash in the history of its operation, it's not easy to value that. So even if there is negative cash flow during the initial periods, it's okay to not generate cash right now. But we expect the company to make cash flows positive, maybe in the near future, or at least in the distant future. And they should be able to compensate whatever has not been earned today. And that has to be accumulated in the later years. If you don't earn today, you need to earn more tomorrow. As simple as that. But we can value a stock only if it has the potential to earn cash. If it can never earn cash, we can't value them. So to give an example, can we value gold? Not really. Unless gold can make something happen. If you produce a product based on gold, that's a different story. But if you buy gold as an investment, do you make money out of it? Speculative income. Yes, market forces determine the rate that can change, so your income varies. So that's a different story. It doesn't have a value of its own based on cash flows, so we can't value that. Can you value a lot, a land that produces nothing out of it? Not an agricultural land. Nothing can be produced out of it. It's barren land where there's no building, can't be rented out, has no cash flows. Can you value it? No. But does it have a market value? Yes. Does gold have a market value? Yes. So can you buy something without valuing it? Without using the cash flows, either today or tomorrow, and just take the market value and be happy with it? That's up to you. I would value something based on what it can produce. In the long run, I don't need to care about the market. Mr. Market does not reward speculation in the long run. Probably it does during a very short period because market forces can change. Volatility can change. Volatility can change the underlying price, but can't change the underlying business. Cash flows are based on business. You would be much safer investing in something that you can value. Think about it. Will you invest in a CD, fixed deposit, without knowing how much it can give you, without knowing the returns? Will you invest in a fixed deposit in a bank? No, you would ask them. If I invest something today, how much would I get tomorrow? What is the rate of interest? You would ask them. Similarly, if I invest in a business, I need to ask myself, how much can I make out of the business? What is the cash that it can produce tomorrow? Will it go up or down? If it goes up, then what is the price I can pay today? If it's going to go down, then how much is the price today and how much do I expect it to go down? And if I feel that it will go up later in the long run at that time, then I would be looking at the price and determine what is the value at that time. So today, I can look at the price and I can look at the value based on the cash flow that I can predict. that I can assume based on a lot of factors. Is value investing very accurate? Maybe not. But at least you get some ballpark. You know how much you could earn in terms of business income. If you buy a business, you would look at it differently. You would not look at market prices. If I buy a shop nearby, will I think about what I would get tomorrow if I sell it? No. I'm interested in doing the business. I want to do the business, make cash flows, and that is my earning. How does that change when you buy a company in the stock market? You buy the same company, but if you buy it in the stock market, you suddenly look at market forces. Since it's priced every day, volatility is high, and you want the pricing every day, and you look at the pricing every day. Does it really help you? No. What you need is the business income. Think about it and put your comments down below. So basically, if you don't know the value, you expect market forces to determine the price. How much is the price? Based on market forces, based on volatility, can you predict them even with little certainty? Very little probability? No. So can market forces be predicted using value investing? No. If I am interested in buying a company today and I look at the value of it and I feel it's cheap, I buy it today. The price can fall. Can I predict that? Probably not. Does it matter? No. So why do you need to care about the price? If you get something cheap today, you buy it. If you want, you can buy more. If it's really cheap and gets even cheaper, right? So let's talk about an analogy. So you have a sale going on. You get something for 100 rupees. You like the product, you need it, so you buy it. It's usually priced at around 200. You get it for 100, so you buy it. A few days later, you get it for 90. If you really need it, you buy it. Otherwise, you don't care. You anyway got it for 100. That was a good deal. Same is with stocks. If you get a good deal, take it. You're not going to sell it next day. You're not going to sell it next month. You buy something if you feel it's good for the long term. If you buy a shop nearby and want to sell groceries, you buy it not to sell it tomorrow or day after tomorrow. You at least want to hold it and see how the business goes. The business is not going to do well and not able to manage it, you sell it. That's a different story. The underlying business changes, you sell, but not because of the price that you get in the market. That's the basis of investing. Another question is, do I need to buy all the time? If I don't see value, should I buy it? Because the price is going up. I don't know whether it's going to come down tomorrow. Should I buy it? No. Price changes, yes. But do you need to buy even if there is no value just based on momentum? The answer is a simple no. You don't need to buy it. You buy when there is value. You don't need to hit all the balls. When you play a test match, you decide which balls to pick and hit. You don't hit all the balls. You don't need to hit all the balls. There are ample opportunities in the market, and all you need is to wait patiently and pick the right balls and hit them as hard as you can with smartness and proper methodological approach, and being consistent with your approach makes all the difference. I hope this session was pretty useful. Please leave your comments down below, and also don't forget to subscribe to the channel. I'll be uploading more videos which I believe will be useful to you, and I want your feedback and your questions so that I can make it really helpful for you. And this is a channel for you. Thank you. Bye-bye.